these producers really, if they're not going to invest in expansion, then really there's only two things they can do, three things. They buy back stock, they increase their dividends or capital returns, or they do M&A.
Righto, money miners. Bloody strap yourself in for a bloody JD masterclass, eh, Trav? Jeez, great for us. Because we didn't have to do any of this. JD, flying the flag in Melbourne for the money miners.
Indeed.
He's on a FIFO arrangement.
Collins Street,
and they've got a few different funds. So we got right into the weeds in my research, but they've got a main value fund, and then they've got a couple different special situations funds. They've got a convertible note fund, and really did a deep dive into how they like to structure these things, because it's really fascinating. They sort of pick these thematics, and a lot of the money miners might have picked up on this because they've done one with the gold space, and they've picked a thematic, and they've thought, this isn't worth just an allocation in the fund. We're going to go real deep into it. We're going to start a whole other fund for it.
Yeah, I mean, they've been cornerstoning a lot of these junior gold
cap raisings, bloody everything. Yeah. So them popping up quite often. Was that one of the only thematics, JD, or there's a few they're running?
Mate, they had a big thematic wrapped around uranium, and they've sold out. They sold out years ago. So that was fascinating to unpack as well. And just chatting with Vas, there's a few other attributes of his, as well as how the guys like to invest there, that sort of really stood out to me. They've got this complete aversion to the short term, which really spoke to me. I really liked that. They don't charge management fees on most of the products. The main value fund, which is very reminiscent of the early Buffett partnerships before Warren Buffett started Berkshire Hathaway, or took over Berkshire Hathaway. And I just loved the skepticism. Trav, you would have really liked that bit too, that Vas has of the world, and a pretty sort of tempered mentality. Always thinking things aren't excessively great when everyone's saying that, and they're not as bad as people always sort of tend to say that they are. So that sort of mentality, I think, makes for a great investor, and it was really cool to unpack that with Vas in the interview.
I reckon, and God, if they're going balls deep in bloody all these junior goldies and everything, they must obviously do plenty of DD to make these decisions, because especially considering a lot of these junior goldies don't have VRIFY, because if they had it, wouldn't it just make it a seamless process? They're probably in more.
Well, maybe they're only investing in the gold companies that have VRIFY, Matty, because it makes DD easy. Maybe.
I don't think. And I don't know if all of these.
I should have put the question to them. I should have asked.
Well, and we talked about it last week, boys, because VRIFY it exposes companies if they have something to hide.
It does.
Because you're chucking it up in 3D. Because I'll show you. I love a good ore body, boys.
I
love a ripping ore body.
More than you love buying
makes the world go round. You can have 99 problems, but an ore body ain't one if you got a good one. I'll show you
That's
an
your
example.
Investment strategy, mate.
I'll show you a bloody example. And this is, I bloody like this shit. The Bellevue Gold VRIFY deck, which is on the VRIFY website. So...
awesome.
Bloody, mate, as I said, it's a stonking ore body. Let's take a tour, a bit of an underground tour, boys.
I'm ready, mate. Can you explain this stuff to me?
Let's do it.
At least we're focused on the ore body, not the sneaky bloody $30 million Zenith capital raise they did last week. But let's have a look at the Bellevue.
Matty, is this an ad for VRIFY or Bellevue? Just want to check.
Well, lucky they're first movers, so this is what we've got to work with. So we can't bloody so look here. You can have a look at the sat shot, see what's in the district. So this is where you learn about the region and the place. So have a look. Shows our bloody right on the bloody next to Cosmos, which we know. Pretty skinny tenement, but I've always heard it's a very skinny tenement. That's the stuff in approval. Shows what's Agnew down the road. Then, mate, you can go to what the site looks like, what the layout is. Let's go underground. Oh, have a look at that.
Mate, that was a wicked transition. Better than your editing.
Here's where you can actually bloody see the ore bodies. So they talk about the deek, trying to get down to the Deakin main. That's sort of the the big high grade area they're chasing. That's that Tribune stuff they're bringing on. Now you can even look at the planned development, like where it's at the bloody moment, where it's going in the next years. So right, here's the bloody 2024 plan. So it shows right. Here's the stopes that are going to be coming out.
Oh.
There's the development to go in. I'm in bloody heaven here looking at underground shit. Mate, you can then you can even
go
look
underground.
You're like, right, because they're going for that, the Deacon, which is down here. So that's the high grade area. So you see, right, that's when they start stoping the top of it. Then you're like, right, where do they get to in 2025? That's when they bloody start progressing it more. They're approaching that Deacon North as well. And then 2026, you're like, right, where's the mine at? So that's like, that gives you like, right, this is what the whole 3D of the mine is going to look like in bloody 3 years' time. And then you can actually go to the life of mine plan. Look at that flicking around. And you're like, right, there's the bloody, that's where all the bloody humdingers are. You can like, right, because they talked about, right, where's the bloody flat stuff? Because it was like that flat portion of the ore body. So it's like, right, I want to have a bloody look at that. Here's a bit here. So it's like, right, that's obviously in the life of mine plan. It's not coming out till later on. See there, boys, that's how you do they're called like flat backing and stuff. So you see, jumbo drive, then a jumbo drive beside it, strip out in the guts, another bloody, and keep working off it because you can't stope it. So, and then you look at it, it's like, right, obviously the Deacon and the Deacon North are the bloody main dingers. So from that you can say, right, 2025 onwards, once they're stoping out these high-grade areas down here, she's going to be a bloody cash machine by the looks. So, but still a bit to get there. So, mate, it's bloody, look at that. Just 3D interactivity, chuck your ore body up, because if you ain't got anything to hide, why not chuck it up there on verified?
Get verified.
Bloody simple as that. So, mate, you can actually learn about, for an investor that might be from, say, the finance world or a non-mining background, actually start having a look in detail of what a mine looks like.
It starts to make sense to me, Matty, when you swivel around with the mouse like this. I will point out that that the team at VRIFY, they actually have lessons to be trained in order to present properly. I don't know what you're going to get for this is your first go at presenting, but I'm going to give it a fail because Steve showed us a much better presentation than you've delivered here, Matty. This is just a tour,
This is live.
There's a narrative, there's all this sort of stuff, but the whole premise is like this interface. You do it on an iPad. Everyone in the rooms are watching it, and they're following your story as you tell it. And that story isn't just what the underground development looks like.
It's not my fucking story. It's Bellevue's story. That's all. I'm not bloody selling it. I can tell you that. I'm selling the fact that it's like, right, once they get down here, they'll make heaps of money. That's all you need to know. But mate, pretty unreal. Good way to bloody there is no better way to engage your investors and your bloody audience than use and verify. But if you got a shit ore body and you got to spin it around in 3D, but hey, it might be a good one and it's hard to show in 2D. So verify is the only option. Mate, get on board. Yeah, links in the show notes. Grant at VRIFY. He'll hook you
Grant an email.
up.
That's it.
Bloody
awesome. Appreciate it,
bloody
VRIFY.
love it. Right, all Collins Street. Make sure your bloody clients have got VRIFY because that means they're not hiding anything. Let's get in to the chat with Collins Street Value Management. On behalf of JD, here we go.
Alrighty, money miners. We've got Vas Piperoglou here from Collins Street Value. Thanks a lot for taking the time to join me here, Vas.
Thanks, Jonas. Pleasure to have you.
Beautiful. We're keen to sort of get into this discussion. We're keen to sort of seek you out for a few different reasons today. And, you know, it's a pretty interesting time in the markets. You've got everything going on, commodities in particular, which is sort of our focus at Money of Mine. So I'm keen to sort of pick that apart. So I think the way to go through this one will be getting into your investment style. I'm sure the listeners will be keen to hear that. And then seeing how that influences how you think about the macro and then onto the micro and your way of looking at thematics and those sorts of things. So the first thing that comes to mind going through the Collins Street Value website and these sorts of things is it's pretty obvious that it's two of you guys that really run the fund and you've got your team as well. But I'm interested just to hear how decisions are made, how you have that relationship with Michael, the sort of co-founder of the business, and how you ultimately end up agreeing on investments. Yeah,
so I guess from a stock picking perspective, I mean, fundamentally we are value driven. So, kind of regardless of the type of situation, whether it's a turnaround, whether it's a one-off specific, whether it's a bear market for a specific commodity, we are pretty tight, and we don't like to pay up for investments. When it comes to decision making, we have a pretty simple rule in so much as we need unanimous consensus. So, for example, if Michael came up with an idea or a thematic and ran that to ground, he would need to present it to me, and I will have to obviously do my own high-level research. And unless there's consensus, we don't do anything. And that's not only for new investments, but that's also for topping up existing investments. That's also for reducing existing investments. We kind of feel that, we're not a board of 20, but if there's two of you, and you do think in different ways, although we are both value investors, we do bring different aspects when it comes to the analytical side of things. We need consensus, or we don't do anything.
So the way the fund came about in late 2015, early 2016, there was a pretty distinct decision that the two of you made. You must have obviously made consensus on this prior, to not really charge management fees across the value fund and most of the other funds that you've sort of put forward. I'm firstly interested to hear, did that make starting the fund easier?
That's a good question. Did it make it starting it easier? Again, we're pretty, I guess in most things in life we do, we're pretty contrarian, and I guess the fee structure is a little bit different to what might be out there in the Australian funds management world. We actually got that idea from the early Warren Buffett partnerships. So that's where the idea came from. But specifically with setting up the fund, whilst we had many years of track record running discretionary accounts, because previously Michael and I worked for a boutique firm in Melbourne, and we used to manage individually managed accounts. So, I would have 20 or 30 clients, Michael would have 20 or 30 clients, and everyone had a separate mandate, and it was kind of like you're running 20 or 30 different funds. So whilst in theory it made sense, in a practical matter, it was pretty difficult, in my opinion, to execute to its full potential. So we did think a fund structure where everyone invested in the fund was perhaps the simplest and tried and means tested of setting up, I guess, a long-only portfolio. But, how do you attract your first clients when that fund doesn't really have a track record? So, whilst we thought people would obviously back us, they would understand our philosophy, we may have one or two stock ideas that we would put forward that, were going to be the first investments in the fund. We did think we needed a bit of an edge on the fee structure. And to put simply, kind of, if we don't make money for our investors, we make $0. And so I guess we felt at the start it helped us attract some clients. Most of our clients at the moment are individual high net worths. So it's direct to individual high net worths. We don't really have institutional money yet. And so, I guess from a business perspective, we took a risk because, you're starting a new business, you're leaving a previous business. We both had families. We both, I believe, had mortgages. And so, we took a risk, but we thought the risk was justified considering, we really wanted to build a business for the long term. I can't actually remember how long it took before we charged the first fees, but I don't think it was much longer after the inception. So we did speak to what I find interesting though is, and again, forms part of our, I guess, investment ethos. We spoke to a couple of industry veterans in the funds management arena, and both of them said, we're going to fail. This fee structure is not sustainable. You're not going to attract capital. And whilst we were thankful of their feedback, we didn't believe in that. And here we are 8 years later, and we have found that for us and how we invest and how we think, the fee structure fits perfectly.
That's fascinating. So you touched on contrarianism at the beginning there, and then it was sort of running right through the little story you told there. So I'm keen to unpack that a bit more. You also had a quote in an interview that you mentioned before we started speaking that really screamed out to me. It was something to the effect of, if the market likes it, we kind of stay away. And I'm interested to hear how popularity in the ideas that you have changes your perception of them or your process in making the ultimate selection.
Yeah. So again, this is very high level, initial thoughts without delving deep into the DD. Clearly, if everyone loves an idea, whether it's a thematic, whether it's a specific industry or a stock, I do get nervous, because if everyone's touting it, then surely it's all in the price. Again, I'm not trying to toot my horn, but a good example, the most recent example, was last year. We generally aren't the best clients for the Australian stockbrokers, because we usually just do things ourselves and don't really follow what they say. But I remember vividly, and I'm not going to mention the name, but a well-to-do stockbroker in Australia tried to get some business off us last year, and they were just touting the lithium sector. And I remember after the phone call, I turned to Michael and I said, I just don't understand these guys. And Michael's like, why? And I said, well, again, I'm not a resource specialist, we're generalists, but normally, if you are chasing a commodity that's already gone up 10 times, normally the risk is to the downside and not the upside. And I guess we see that through in, throughout. And so generally speaking, if everyone loves it, we get quite nervous. And the opposite is true. If we like a thematic or a company that we believe is misunderstood, or that we believe has reasonable fundamentals and a pretty good backing of intrinsic value, we start to look, and that's run throughout pretty much all our investments we've made via all the different funds as well.
So that sort of leads me to think about conviction, because you run a pretty concentrated, you like 10 to 15 stocks from what I could sort of surmise in the research. And, there's a sort of common value expression, like why chuck in your 15th most favored pick, those sorts of things. And I think you also said in one of those interviews, we're sort of either all in or we're not in at all. That's, I guess, part of your nature. But how do you think about conviction? And I guess, how does that tie in with picking baskets as well? Because you tend to find thematics that you like.
So you are right. Most stock investments we make, we always go in with the intention of it being a reasonable bet of the portfolio. So, for example, most new positions, we ideally like it to be 10%. 10% of the fund, great. 10 ideas, great. Unfortunately, practically, that doesn't always work out. There are certain circumstances where we start buying and the stock, kind of runs ahead, and then we just wait and be patient. Also, because the fund has been growing FUM pretty much every year, including during COVID, kind of as you're getting new money in, it clearly dilutes your older positions, and doesn't necessarily mean you think it's a sell, but perhaps at the time you've got more FUM, there's not so much of an upside in how you value these specific stocks, and they get diluted. So again, if we had constant FUM, ideally the 10 to 15 would be ideal. We do run slightly above that, because when we have a specific thematic bet or investment, usually we prefer to invest in a basket. So at the moment, for the Collins Street Value Fund, the main fund, one of the thematics that we like at the moment is the gold small to mid-cap space. Again, because it is a thematic investment, we've decided to invest in, I believe it's around a dozen different small to mid-caps. And so that does push out, obviously, the number of positions. But when we analyse our fund, we don't say we have 12 gold stocks. We say gold is one thematic and it represents X% of the portfolio. So we kind of count it as one, not 12 separate.
Gotcha. So how else does the investment process differ in picking a thematic versus just picking a beaten up stock?
Yeah. So most of the time, and I'm trying to think of a case where it wasn't true, most of the time our thematics lie in the resource sector.
Yep.
And because it is a resource sector, because unfortunately most resource companies don't have, in essence, don't have that typical competitive advantage you might find in an industrial, we do like to spread our risk. And on the separate front, we do, and we're not scared to invest in small caps when it comes to a thematic, whereas we might not really invest in a small cap if it was a specific industrial company because we couldn't buy enough of it to make a difference. So yeah, most of the thematics are resource driven, and we do prefer to spread our bets over more stocks than we would have otherwise. And it's also, I guess, it's just how our funds managed at the moment. We're not managing billions of dollars, but we're managing a lot more than 10, 20 million. So it's just, if you're looking at a specific gold stock that you think is undervalued or has top management and its market cap is 50 million, well, it's going to be pretty difficult to make that a 10% position.
So we'll crack into it in greater detail later on, but just in building that basket, do you then go and do fundamental analysis on each and every one and then pick them on their individual, balance sheet strength or whatever?
We do. So for the gold, we looked at multiple variables, but on the top was management. So we looked for companies that have had management that have been there and done it before. I don't believe there's many gold stocks we have where management have not been proven in the sector. So we look for proven management. The second one is we always like, it doesn't matter how small or how large a company is, we always like a lot of skin in the game. So we, again, most of the small cap gold stocks, the CEOs have plenty of shares. The third most important point is obviously project and jurisdictional risk. So most of the stocks in the Contrary Value Fund, they're mainly in Australia, so a jurisdiction we trust. We also, I guess, the most important part of a resource sector, including small caps, especially if it's unloved, such as the gold space at the moment, is at the end of the day, the biggest risk is dilution. So, you could have an amazing asset in an amazing jurisdiction, but if the markets are tough and the company needs to significantly dilute you every 6 months or every 12 months, it kind of defeats the purpose. So we made sure that the stocks that we entered either have already conducted some capital raising initiatives, or we were part of the solution that made sure that they had at least 12 to 18 months of liquidity left. And hopefully, the sentiment can turn during that period, and hopefully future raisings aren't as dilutionary as what they may otherwise have been. So really they're kind of the four fundamentals when it comes to the small gold cap space. Obviously there's a lot more detail into that, but on a high level, that's kind of what we look for. And it's actually not easy because I don't even know how many gold stocks are on the ASX, but I suspect it's hundreds, in the hundreds. And we only found ASX listed 12 that we feel are investment gradable.
So picking up on the thread of management, I guess more broadly to start with, obviously you've got alignment, but is actually speaking with the management face to face, is that a must?
Look, originally I would have said yes, but as the years go by, I am slowly changing my opinion. If you look, at the end of the day, any manager, whether they're good or bad, usually is smart enough to tell you what they think you want to hear. And yes, you can you can obviously have a good gut feel on whether they're spivvy or not, whether they're trustworthy or not. But for me, the proof is in the pudding and the numbers don't lie. So I now much rather prefer to read, obviously, most of the annual reports, quarterly results, presentations, and sometimes do, I usually get more info by speaking to a company's competitor than the company itself. So not necessarily. I still think it's good practice. I still do it most of the time. It doesn't mean I get more out of it than I, just reading up on it. But it's one of those things where it's not necessary if you do all the research, but it's a good. I think it gives you, it gives you some good things to think about and to look out for in the future for that, the company specific. So, yeah, I hope I answered that in a weird way.
No, it's all good. So the way you've structured this investment in gold that we're touching on here is pretty unique. You've actually structured a special situations fund with a specific time horizon in mind, and you did the same for your oil and gas, your resources services model as well.
Yep.
So, I mean, that leads to an obvious question of selling the business and knowing when it's time to, I guess, really sell the basket of businesses.
So, okay, so I'll try and work backwards. So generally speaking, any new idea or thematic pretty much always comes out of the research and the DD we've done on something related to our main fund, the Collins Street Value Fund. So it would have been a couple of years ago. I can't remember how I got led to the stock, but I started to look at, I think it was called Mermaid Marine at the time. It's now called MMA Offshore.
Yep.
And it was Australia's only listed offshore services vessels company that basically services the oil and the gas sector for offshore. After doing a lot of DD on that sector and that company, and for which we subsequently, I believe for the fund, bought just shy of 5% of the company for the Collins Street Value Fund, we realised that there was huge asymmetry in that sector. Now, unfortunately, Mermaid Marine or MMA Offshore was the only way to gain exposure on the ASX, but we also realised there were quite a few companies listed in North America in that sector that during the brutal bear market that sector had, entered Chapter 11 bankruptcy. They came out of bankruptcy. They recapitalised the balance sheets, and some of these shares were trading at 0.2 or even 0.15, so 15% of the replacement costs of their fleet, yet they had net cash on balance sheets, and you were seeing green shoots within the sector. So because our main fund, our mandate's only for the ASX, we thought, okay, well, if one of our investors wants to also invest in this sector from more of a global sense, let's set up just a one-off special situations fund to invest exclusively in that sector. Our mandate was for 3 years. We thought within 3 years we would see the re-rating, and the intention was to wind up and return money to shareholders. So for that fund, it's been over 2 years and it's coming up to 3 years. We've actually taken some profits off the table, and as of last month, I believe we've returned approximately 120% of the capital back to investors. So they got all their money back plus 20%, and we still have, I think, another 80 or 90% left. And so, we normally, when we're buying a specific stock or a sector, we do come up with a future valuation or a future intrinsic value based on fundamentals. So, for example, we had an average EV to EBITDA threshold we thought that these offshore service vessels companies will earn. We understood that this sector, will never trade at premium. It's always going to be a fairly capital-intensive industry, and the oil and gas sector in general, I guess, because of ESG issues or potential issues is always going to trade at a discount, but it kind of doesn't matter if you're buying something at such a low price and you see green shoots, you tend to do well. Now, again, on the flip side, the same type of thinking came out with gold and gold stocks. So whilst we have a specific, I think roughly at the moment, 15% of the Collins Street Value Fund is in gold stocks. We did realise that obviously whilst Australia is home to a lot of good quality small to mid caps, obviously, there's also some reasonable prospects in Canada and America. And so we thought, well, special sits number one was pretty successful. And we thought, well, again, without trying to recreate the wheel, without trying to distract us too much, why don't we do the special situations fund number two, to invest in gold and precious metals globally. And so it was a pretty easy story. I mean, so a lot of the ASX stocks that are in the special sits too are also pretty much the same gold stocks that we own for the Collins Street Value Fund. And for the international stocks, obviously we had to do further inquiries and due diligence, but we did bring on a new analyst, Nick Torelli, that's really been spearheading that fund.
It's fascinating. So it's great to get a good feel for how you sort of look at the market more broadly. I'm keen to sort of put that into a bit of a macro sense now. And obviously your value investors, as you've described there, but we're in a pretty wild time in the market, like I sort of said at the top of the show, and you've got a bunch of conflicting bits of data, I guess. So you've got the ASX 200, NASDAQ, all these things at all-time highs, and then you've got strong jobs data, but you've got inflation a bit, sticky and those sorts of things. So I'm interested just to start with to hear your thoughts on the overall market, where we're kind of at.
Yep. So it's interesting you said conflicting data, because this morning I was speaking to someone else in our office, and I feel like every week there is a new set of data that dismisses the previous week. And I think we're all becoming too data dependent on data that might not be that reliable. That's number one. And I say that because the jobs data in the US out Friday it just smashed the lights out. It was nearly 3 times expectations. And so, then on Friday, the US market got worried that, that means that rates aren't coming down. Or not coming down as soon as they ought to be. So I don't always believe in the headline datas or the month-to-month datas. I think you've got to look at the trend and the longer term. So we are in a weird set of circumstances because clearly inflation, the trend of inflation is coming down. I don't believe it's going to be at 2% for the next 10 years. My view is we're going to have a higher inflation over the next 10 years than clearly what we had over the previous 10 years. Yes, I believe interest rates may have peaked, but I don't think they're going to be coming down as much as people expect or as quick as people expect. But the direction is obviously no more hikes, at least in the near term, and coming down. But yeah, it's a weird scenario where you're getting headlines every week that sometimes makes the previous week's headlines obsolete. I think another thing that people don't understand in Australia, or maybe they do and just I haven't picked up on it, is there is, in my opinion, because of geopolitical facts and issues, I think the world in the next 10 to 20 years, it's going to be bifurcated. So you're going to have kind of the Sinosphere and the West sphere. And obviously, the smart companies and the smart countries can play to both. Sometimes you can't, but don't believe everything you read in Bloomberg. And at the same time, don't believe everything you're hearing out of China. It's kind of, you've got to kind of be in the middle and realize things are never as bad as people say, and things are, in my opinion, never as good as they say either.
Pretty measured sort of way of looking at the world. How did that, interest rate increasing cycle that we just touched on, how did that sort of play out against your expectation?
The one thing that I was very pleased with, and is probably one of the reasons why I'm so bullish the gold thematic, is the rate rise from effectively in the States 0% to plus 5%. That was pretty unprecedented on such a short time frame. So that's number one. So number two, if someone said to you rates are going to 5% from 0%, you would think, okay, well, there's going to be certain sectors that are going to blow up. We did see some regional banking issues in America, but they were pretty contained. So I guess the strength and the resilience of the economy has surprised me. And number two, with respect to the thematic in gold, I mean, if anyone told you, interest rates are going from 0 to 5%, you would have thought gold is going to be completely smashed. Like, the cost of holding gold is, it doesn't earn a yield. Anyone would have thought that gold would be smashed. So the fact that it didn't, the fact that it went up, just solidifies, in my opinion, and I could be wrong, but hopefully not, that it should be an interesting couple of years for the precious metal space. But yeah, look, I guess what we find usually works as a value investor is you don't always have to be right to make money. You can sometimes only be right on half kind of your predictions, but because you bought something at a cheap enough price, you can still make money. On the rare occasion, you can still make a big mistake on a specific investment, and you can, still make a little bit or break even. So for us, we don't always have to be right on everything. To be honest, we liked the gold sector before the interest rates went from 0 to 5%, more for geopolitical reasons and more because we actually saw that, record central bank buying. We were wrong on obviously the interest rates. I thought it would have affected gold a little bit more than it did, and it hasn't. So yeah, it's one of those things where hopefully if you buy right and you're also right on at least half your kind of predictions or theories, you can still do reasonably well.
You touched on China there, and I'm keen to sort of unpack that a little more, around the data and things. And this has sort of been more prevalent in my mind, I guess, because I just read about a bunch on the weekend.
Bloomberg?
There was a couple on Bloomberg. There was, I think, New York Times as well.
Yeah.
These things they've been around for a while, and so we got the population is just a fascinating thing to sort of view from the distances. And then you've got the real estate market and all these sorts of things, and a sort of massive era of investment, which was just phenomenal, but it appears to be coming to an end. And obviously you're a value guy, but I mean, materials makes up 25% of our market here.
Yeah.
That's just the surface of the links we have to China.
I do have a disclaimer I have to say from a personal level, and this is not fund related. I think I have about 15% of my net worth in Chinese related stocks listed on Hong Kong.
Okay.
And this is a recent thing, so I am talking my own book, but I think I'm very skeptical because literally, I mean, I read a lot, and every day there's something on Bloomberg that is really negative China. So I'm not normally a conspiracy theorist, but you got to start to question when every day there's something negative. Again, I think everyone realizes America and China are at loggerheads, and they're probably not going to be too friendly over the next decade.
Yeah.
So if you understand that, and then you understand that sometimes there are things happen for strategic reasons, I firmly believe it's not as bad as people think. I mean, one thing people have to remember is whilst a lot of bagging China, and yes, their property market's falling, and yes, their stock market's lost 6 trillion from the peak, but whether we like it or not, it's still a fairly closed economy. And it's pretty hard, or it's almost impossible in my opinion, for a closed economy to self-destruct. If China wants to direct money in a certain sector, they will do it. And so, yes, their population is declining or they're getting aging, but the same thing can be said about Japan, right? But everyone's
30 or 40
years, but everyone's touting Japan now. Look, I don't think it's as bad as people say. I think for the smart, astute investor, if they can pick monopolies or long-term compounders that abandoned China or China related, and you're trading at less than cash backing, or growing earnings by 15% CAGR, and you can pay 9 times. I think the risks are fairly minimal at today's levels. You are talking about forward-looking earnings in China that is lower than it was during the GFC. So, it's pretty bearish out there. I understand why most foreigners don't want to own anything China related, but at the end of the day, I really don't think it's as bad as people think. I still think within my lifetime, it's going to be the number 1 economy in the world by size. And so, I don't know. I think it's going to be okay.
That's fascinating. Another one that I read on the weekend was Chip War. I'm not sure if you've seen that one. That was fascinating to sort of unpack.
Yeah, well, I think, again, I wish, and I'm not anti-America by any means, because obviously I believe in democracy and I love their entrepreneurial spirit, but sometimes they fail to think about the unintended consequences. And I'll give you another example as well. So whilst America's cracking down on the chips, and they want to reduce China's ability to source chips from the Western world, it only does one thing. It makes China become more self-sufficient and pushes them to speed up, really, their transition to effectively have their own. That's the only thing it does, right? And it looks like that's what's happening. Another thing was, and I think when, and sorry to bring up some geopolitics here, but, obviously when Russia invaded Ukraine, that was devastating. Like, clearly it was unprovoked, and it's still going, and it's probably been an own goal for Russia. But when America decided to freeze all of Russia's US denominated assets, again, I think the intent was the right intent, but it has unintended consequences. And really, I've actually started to see a lot of other countries that are both friendly to the Sinosphere and to the US are slowly questioning how safe their assets are in the US or the US denominated system. And, I do believe some of that diversification that's been coming out of USD or USD assets is probably making its way into gold as well. And so that had unintended consequences. So again, it's fascinating. I know why they're doing it, but I think it actually has the opposite effect in the long term.
There's another sort of, very broad strokes thing that's been prevalent in markets for a long time now, but the last 3 or 4 years, and it's ESG investing. And, this was massive at an institutional level. I'm interested to hear how you see that changing coming out of that 2021, 22 period. Well,
I'm not sure if you agree with me, but I feel like it's already changed a bit.
Yeah.
So, I mean, ESG is an interesting one. Clearly, all companies should strive to be as environmentally friendly as possible. Yes. But, we were scratching our heads when, for example, if Victoria wanted to boost the EV adoption, and I think there was a period, or it still might be, where there's some incentives, some cashback incentives to buy an EV. Well, that's great, but when you're plugging it in at home and the electricity is coming from a coal-fired power station, I just don't know if that makes sense. And so there's a lot of hypocrisy in certain things, and the unfortunate thing about the transition, and I guess everything related to ESG is the world we live in and the infrastructure we live in has been built over the last century, right? And things take time. It's like things are not going to take 1 or 2 years and we're all going to transition. It's going to take decades, multi-decades to transition away because we just do not have the infrastructure. And so, yeah, look, I think every year, renewable energy and responsibility is going to be increasing, but it's obviously coming off a low base, and unfortunately, it takes a lot of time. And also, it does cost more. There is a cost. Obviously, there's a benefit, but there's a cost as well. And so long as people are willing to pay more for things, then obviously their transition can continue. But where it becomes difficult is where people don't want to pay more for things. Then it's kind of hard for things to be built that make economic sense.
Yeah, it seems like there's a bit of a lack of scientific principles leading some of the policy decision making.
Yeah.
On the on investing in certain sectors that are shunned by institutional investors, the means of return seem to be buybacks, M&A, just capital returns in those sorts of methods. Do you ever see that changing?
No, I don't, because I guess if you are a coal company or an oil company, normally, and let's talk specific about commodities, normally the pricing mechanism works in most commodities. Normally, if you've got high prices, that induces supply, great. Then prices come down and the cycle repeats. But for commodities that are branded ESG unfriendly, even though demand will probably keep going up for the next decade at least, and for oil, I think demand will keep going up till 2050, but that's probably another conversation. There is still the uncertainty about, well, what's going to happen in 5 years? Are they going to tax us more? What's going to happen in 10 years? And so because the government policy is creating uncertainty on the supply side, it is creating a bit of hesitancy on these producers. And so these producers really, if they're not going to invest in expansion, then really there's only two things they can do. Or three things. They buy back stock, they increase their dividends or capital returns, or they do M&A. So I think for most investors, generally M&A or a plethora of M&A is not a good thing, because you get the investment bankers involved, and normally the acquirer pays too much, and then eventually the skeletons in the closet, and so I think again most investors would prefer higher returns via dividends, capital returns, and buybacks. So I don't think it's a short-term thing. I think it's here as long as I can see, whilst ESG creates uncertainty on the supply side.
Yeah, and it seems totally warranted, right? We saw what happened in Queensland in 22, the shift in scaling royalties on coal, and the mechanism which supply wouldn't traditionally come on for higher cost producers is kind of switched off, because even they can't make money yet.
Yep. That's why it's the Goldilocks. Like I always tell investors or anyone that asks, oil and gas and coal is kind of like the new tobacco. Now, I'm not saying it's as bad as tobacco, because clearly smoking is very bad for health reasons. But it's got that weird sweet spot where you can see those that are happy to be in the sector and to continue will be making some reasonable returns by not doing much.
And what about the sort of distinction between met coal and thermal coal, right? I mean, I think it's 12 to 15% of the market goes towards met, and then the rest is thermal, but they are really, put in the same basket by investors.
They are, and they shouldn't be, but you're right. I think we don't hold it anymore. We've decided to take our profits, but one of the reasons why we invested in Coronado Coal a couple of years ago was for that specific reason. Remember, thermal coal was in the headlines for all the negative reasons, and thermal coal price was really low. But you look at the met market, and then you look at steel and steel consumption, and you kind of scratch your head. You're like, well, I don't think met coal is going to be replaced anytime soon for the main ingredient. And because it's coal, people put it in the same basket. But you're right. They're two clearly different end markets. And again, it's something that surprised me. I I would have presumed that the met coal market, would be, from a pricing perspective, over the last couple of years, would be stronger. But I think the opposite happened. Now, the hard part is how much was that due to the disruption of the war in Ukraine or not? I don't know. But it's funny how, you would think one thing and the opposite thing happens.
And you've also had massive sort of cost inflation eating in on the other side. All right, so we've talked around the gold thing for quite a while, the fund and the thesis across both funds, really. But I'm keen to really dive into it now. So your business partner, Michael Goldberg, sort of broke it down in a Livewire piece, and he highlighted 4 key reasons behind a re-rating. And we've talked at length about one of them, the sort of pivot in central bank policy. M&A is another one. Operational improvements is the one I want to tab into, and then geopolitics we've spoken about as well. But to start with, how many do you think you need to see for the thematic to go to plan?
We're talking about the gold thematic?
Yeah, so
specific.
The special situations fund to sort of...
Number 2?
Yeah.
Yep. Look, I really don't know what it's going to take for the gold thematic, or let's talk specifically for the gold stocks to catch a bid. I find it very ironic, and this is why we're so excited, because normally when stocks are at 45-year lows, normally the commodities in the short term been on the nose, but it's not. Gold's near its all-time high, so that's a bit interesting. Number 2, you always see the large caps lead the mid caps, and the mid caps lead the small caps. We have seen the large cap gold stocks do reasonably well over the last 12 months, right? Even some of the mid caps. I mean, we were looking at our position in West Gold. We bought West Gold, I think it was 13, 14 months ago. I think we paid about $1.20, and what are they trading now at $2? So they nearly doubled, right? And then I'm looking at some of the smaller caps, and it's like, well, hang on a minute, these things are down 70, 80%. It just does not make sense. So it's, in my opinion, it's not a matter of if, it's when. What is going to be the specific catalyst? I don't know, but could it be M&A? I saw this morning that there was a new M&A, a VRIFY and Silver Lake emerging. I really don't know, but it's going to be something. And if you look at the 2001 period and the 2015 period, over 3 months, I think it was 3 to 4 months, you had the large caps doubled, you had the mid caps go up 2 to 3 times, and you had some small caps go up 10 times. So I'm not saying we need to see those types of returns for our investments to pay off, but I think when it moves, it's going to move very quickly. There is still almost no institutional ownership in some of these stocks. Yet the underlying commodity is doing well, yet central banks, non-Western central banks, are buying in record amounts. And so, yeah, I find it fascinating. I don't know what is going to be the final catalyst that gets it going, but yeah, it's going to be interesting. And obviously, because these are smaller stocks, and because we run a fund, you have to really get set before. Because our philosophy is when things start running, we just hate paying up. I would rather miss an idea than pay up. That's just how we operate. And so, yeah, we've been slowly nibbling. Pretty much every day, I believe, we're in the market buying something related to that thematic.
So you had this investment in uranium from my reading. I think it started in 17-ish.
Yep.
Really at the trough, at the bottom, when it was, a great pick for a value investor because everyone hated it. Reactors were being turned off. Utilities were all sorted.
Yep.
And then you sort of buy in. You didn't do it in the special situations model. You hadn't sort of come around to that sort of strategy
Correct.
yet.
I wish we did.
Yeah, but what really sparked my sort of memory from reading there was that you said it turned very quickly. And these things were, I think I was holding some uranium, and then there's a sort of leg up in 20, and then 2021 in a week or two, these things all doubled or more.
Yeah.
So, that really goes to show what you just said, how quickly the...
Yeah. Uranium was fascinating. So we did start to nibble slowly in late 17, I recollect, but so this was just small little nibbles. And how we did it was, again, we try not to be too smart. We thought, what's every ASX listed uranium company out there? And we got rid of, the guys that just had moose pasture and nothing. And then we kind of worked out, well, how much liquidity do they have and how long can they last? So literally the weighting went into those that could last the longest. And obviously we put the least in those that we thought would need to raise money in a couple of years. So thankfully we put most of our money in Paladin. And I think that's one of the better ones, which is interesting because it was the largest market cap and still is. And so we really didn't make it a decent sized position until some stage in 2018 when we start to saw the main suppliers in Kazakhstan and Cameco turn some of their mines off.
Yeah.
We thought, okay, this is the catalyst. Like, when some low cost production, because it wasn't that high cost, it was one of the lowest cost production, is turning off. That just tells you no one can make money. And so there has to be a supply response, and then hopefully the price action will work. What we didn't realize was how slow moving and opaque the uranium market was. Clearly, the amount of inventory out there that countries hold, it's not really disclosed. So there was a bit more inventory than we would have originally have liked. But it was 3.5 years. We literally did nothing, which really is losing money because it's opportunity cost. And then, it was within a couple of weeks, they started to go up 2-3 times. And then we kind of had rough NPVs of every mine from every company we owned. And granted, these mines weren't all built, and that clearly there would have been a lot more dilution to get it up and running. Yeah. And then, we sold. It looks like we sold way too early, but we were happy with our. I can't remember what we made, 4 or 5 times our money across the portfolio. I just remember when we sold, the NPVs were basing the spot price of like $90 or $100, and it was only 40 or 50, and we're like, well, this is crazy. Yeah. I think it's at $100 now. I'm not sure.
Yeah, I think 106 or 7.
Yeah, so we were happy, but again, we never get the exit perfect. But when you make a good return in an industry that is cyclical, there's nothing wrong with taking your money early. And that's we generally do that, and I suspect we're probably going to do that with the offshore oil services, and probably going to do that with gold as well. That's just how we operate. We like to buy when no one wants it, and when it's in the papers every day, we start to get a bit nervous.
The hardest thing there, though, is sitting on your hands for 3 to 4 years, right?
It was hard. Plenty of times investors questioned the thematic. So they didn't really question us, but they questioned the thematic. Thankfully, we stuck to our guns. And it worked out. And I think that's a good example to show that with patience, what can happen. I don't think the gold sector is going to take as long as it did for the uranium thematic to play out. But patience, you normally get rewarded with patience. And that's why we don't, and I think it's one of our advantages, and this is both from a personal level and also from a fund level, we literally do not care about short-term results, because you can't have it both ways. You can't look to outperform in the medium to long term and expect a linear, short-term rise. And so, just kind of psychologically taught ourselves to not really care about the short term, look at fundamentals. And if you have a high conviction, keep visiting the thesis every quarter or every month. And so long as that's intact and there's no new news, sometimes the best thing to do is nothing.
That kind of leads me to thinking about another stock which has been quite active lately, Carnarvon. And I know you've got quite a bit of involvement, and again, you've been in there prior. I need to disclose first up that I own a couple, but I'm interested to hear, not so much the buying process that seems very true to yourselves, but in August you start to engage other shareholders who aren't quite so chuffed with the nature of the business. It's sort of fully funded, but corporate costs are high. And, you get a process going. It happens very quickly, ultimately, in December of last year. The first sort of question I have is, how do you view Activism as a shareholder?
Look, I think it plays a part in the investment cycle, just like shorting plays a part. I think fundamentally, how we operate anyway is we always normally invest in a company on face value backing management. And so, very rarely would we buy into a stock where we thought management were not doing a good job. So that's number one. So when we first bought into Carnarvon, clearly we spoke to management. We thought, well, they seem okay. They don't seem like they're going to blow things up. We understood that Carnarvon really was an entity that had a minority stake in a project. So I guess I thought, so long as they didn't blow up the money or spend too much or waste it on M&A, there really wasn't much downside. And so that was, the main reason why we entered was obviously the clear discrepancy between underlying valuation from an MPV perspective and the stock price. We became even more interested when they sold half their stake to the Taiwanese outfit. And then if the back of the envelope, you did a look-through valuation calculation, you're scratching your head. You're like, well, hang on a minute, the share should be at least double, maybe more. So again, we were kind of backing management, but then we thought we made ourselves clear, and we thought that was the intention of management to kind of, just continue upon the Dorado investment. And, most investors, I suspect, and including us, invested in Carnarvon for its tier one asset, tier one jurisdiction, exposure, even though it was a minority exposure. We started to get a little bit nervous when in presentations they started talking about acquisitions. And then, we did have a few discussions with previous management. And yeah, we weren't too happy in the direction that they were considering taking it, even though we were led to believe that wasn't going to happen. And yeah, so between that and between all the corporate costs, even though they were minority investors in a specific project, we thought, after 2 years, I think we've been holding for 2 years, I think that's long enough for them to prove us that they are good stewards of our capital. We don't take activism lightly because, it's something that, if you're going to do it, you have to do it to the best of your ability. And so, yeah, we obviously teamed up with another fund and successfully agitated for some change there, and hopefully, shareholders will bear the fruits in the year or years to come.
So, how's the market response been versus your expectations?
That's a good question, because I don't actually thought I can't remember that I thought about what's going to happen in the short term, because normally I don't care about the short term. If I did think about what would happen in the short term, I'm not surprised that it had a bit of a kick up. Again, I think the markets, so not just our fear, I think the market's fear was justified in that they were going to squander their large cash pile for an acquisition of assets or certain assets that really aren't tier one, and coincided with obviously minimal director ownership. So clearly their interests are more aligned in the pay packet, and some uncertainty about the delay from FID from Santos. I think that all fed into it. So I'm not surprised there's been some positive response. And yeah, we're capitalists by nature. It's I think the board have made it clear that they're open for any discussion that makes sense. So, if someone wants to acquire Carnarvon at a reasonable price, I believe they can as an investment. If Carnarvon want to I guess, stay out and look to earn income from the initial first phase of production, they could do that as well. All that we know from management is that they're not going to squander the money. The money's going to be there for either future capex on Dorado, or if there's an offer, clearly to return it to shareholders, and do it in a reasonable time frame. And also, I believe they've cut a lot of costs, because I said, I know the interest rates aren't zero today, and I said, surely with 180 million in the bank, surely the cost can be covered by the interest, which I think hopefully they will be.
You'd think so. You'd hope so.
Hope so.
On the theme of resource services, we've obviously spoken about the oil and gas services, and you had the fund for that. I'm interested to hear how deep you've gone into the more hard rock asset services business. I saw Emeco is one of your top holdings.
Yep.
And has that played out to the same extent in your
Sure.
opinion?
So Emeco is a recent acquisition we've made. Unfortunately, I believe it makes our top holdings because we don't have many holdings, but it's a small position. I think it's less than 1% of our fund. We've been buying every day for quite a few days. We make sure that when we enter a stock, we don't want to buy too much on a daily basis to affect the share price, because clearly we want the lower share price. So we've just been nibbling every day for the past couple of months, and we've only ended up with less than 1%. So even if it doubles or triples, it's not really going to make a meaningful difference. But on the thematic, look, I think it's a reasonable business. It's obviously number one in Australia. I think number one in the world, to be honest, for mining equipment rental. They earn mid-teens internal rate of returns on their assets. It's reasonably run. Ian's a pretty good CEO. They've previously announced buybacks. Their net debt's pretty low. Look, he did make a bad acquisition, but I think he's learnt from that. And so the write-off from that acquisition, I believe the market didn't like, and obviously it's been a bit of a distraction. And so, I understand why it's been in the sin bin for the last 12, 18 months, but you've got a business that has pretty good assets, has low debt. I think it's trading on consensus 5 times earnings. Yeah, you can argue mining services should never trade at premiums, but this is not your typical, boring mining services that just, digs up dirt. They do own the fleet. They do have a competitive advantage. And I do question, I believe there's a large shareholder, some American institution, Black Cat or Black. I think they IPO'd it. And so, I wouldn't be surprised if it still languishes at these levels that they potentially take it out, because I think it's trading at one third of the multiples of his closest peer in North America, and it has less debt.
One question that comes to mind when you mention, replacement costs or NTA, how do you go about vetting these things? You mentioned the same with MMA, offshore. These things can notoriously questionable.
So it depends what type of sector or it depends where in the cycle the sector is. So you've got to be careful of applying NTA according to what the company does during boom times, because more often than not, they overstate the asset valuations, which are, I believe, mainly done on DCFs through their auditors, and they have a DCF and they have a discount rate and blah, 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 and they extrapolate it. And normally that's I guess in good times, larger than what it might have otherwise been. On the flip side, the opposite is normally true. During market troughs or during tough periods of specific sectors, you find that the companies actually mark down the value of their assets more than what it would realize in the open market. And so for MMA, what we did was we literally compared every one of their fleets, so every one of their offshore services vessel sector, with publicly available data we could find on the internet of something similar or the same and the most recent sale price or auction price. And so we did our own analysis, and effectively we came to the conclusion that the book value they had for their assets was less than what the true value was, but we always pick the lower of. So even if we can prove that the real value of a specific piece of equipment is higher than what the company says, we will use the companies.
Yeah, although that is a rarity.
It is a rarity, but
way.
in down times, I'm talking about specific fleet. Like Emeco has trucks, MMA had ships.
Yeah.
It's hard when it's oddball hard assets.
Yeah, unique things.
Unique things. Yeah. So yeah, that's kind of how we look at how we looked at those two sectors. And the same with the offshore oil services sector. These are drilling rigs. The new cost of a new drill rig is in the billions. And so it was weird. You couldn't really pinpoint, because I don't think many companies are going to spend $1 billion ordering a new drill rig, just because of the ESG stuff. And also I think it takes 4 or 5 year lead time. So we were just comfortable on the cash flows. We were paying 2 to 3 times annual cash flows of these businesses that had net cash, and they were trading at 15 to 20% of replacement costs. So yeah, look, when you find there's a huge discrepancy or there's so much margin of error that, if you're wrong 20 or 30%, either way, it doesn't really matter. So, I mean, again, so long as there's not leverage and all that.
Awesome. Well, I've taken heaps of your time. I've got one more question. As I came in, there's a beautiful bookshelf there, and I'm keen to hear, picking a favourite would be too hard, but is there one you've read somewhat recently that sort of stuck out?
Well, the funny thing is, both Michael and I believe we've collated various books that we thought were applicable to kind of, how we think and operate in the investment universe, even though there is a few Napoleon books there, but that's off topic. And I've read all the books, and I tend to, when I read a book, I read it, and then as I'm reading, I highlight notes, and then I type notes. So I've got notes for every book I've read, and then I read my notes once a month on stuff that really stood out for me. So I haven't actually read any of those books recently, but if I had to pick one that I thought really, I guess, appealed to me most, probably, to be honest, The Snowball on Warren Buffett.
Read that again over the sort of Christmas break.
Oh, did you?
Yeah.
Again? Is that you said?
It'd been probably my uni days since I read it the first time, in The Making of an American Capitalist, the Lowenstein one. So
yeah. I think awesome if the younger generation haven't read up on Buffett, I think they should, because if you read any book that's ever written about him and also his annual reports, from a value investing perspective, that's all you need to do.
Yeah. Well said. Awesome. Well, thanks a lot for your time, Vas. Appreciate it.
Thank you.
Righto, brilliant stuff there, Jonas Benedict Dorling. I bloody love it, mate. Keep doing them. I love it. I don't have to do anything.
Appreciate it, mate. I reckon the money miners get a good kick out of that one. I love the perspective of, as we sort of said at the top of the show, a real, value investor. And yeah, I hope the money miners got as much out of that one as I definitely did.
Yes, bloody love it. Right.
Couple partners to thank.
You got something coming up too, don't you, JD?
Well, we've got a few things in the works, mate. We've got another chat with Emmanuel Dat to come up later this week. So I'm looking forward to sharing that one too. He's been writing a bit, he's been tweeting a bit, getting active, and obviously there's just plenty going on in the world of commodities lately. And why not speak with a fundy who's quite up to speed with everything from the energy to the energy transition metals out there.
Very, very good. I bet you mentioned WA1.
To be revealed, Matthew.
Love your work, mate. Right, thanks to all the partners. Verify at the top of the show. If you got nothing to hide, get Verify. That's a new company slogan.
Ooh, I like that.
I like it. Right, InvestorHub also, DSI Underground, SMEC Power and Technology, McMahon Mining Title Services, also known as Managing Mining Titles Superbly, or Managing Mining Tenements, whatever you want. Anytime Exploration, KCA Site Services, Brooks Airways, and K-Drill. Thanks, JD. Love your bloody work.
Oodaloo.
Oodaloo.
Cheers, fellas.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation, or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation, and needs.